So everyone thinks that buying rental properties will make them rich, but most real estate investors, especially when they're getting started out, they buy rental properties and they just sort of get stuck on their returns, and they're getting mediocre returns. They're not making a lot of money, and then they kind of question, wow, what's going on? So if you really want to build wealth in real estate, I'm going to talk today about 8 things you really need to understand in order to do so. So stick around. Hey everybody, it's Randy Wolfe. Thanks for joining me today for this video. So first and foremost, number 1, cash flow alone will not set you free. I talk about it in another video. Cash flow plus equity equals financial freedom. And when you think about rental properties, it's easy to kind of get caught up in just the cash flow. Cash flow is very, very, very important. But in the beginning particularly, it's very slow and typically a really, really small amount of money, especially when you're dealing with single family homes. And wealth is truly built over this period of time when you're accumulating rentals and growing your portfolio. It's really built through appreciation and equity. So cash flow, think about, is kind of paying the bills. If you bought a property today, don't recommend what I'm about to say, but just hear me out for a sec. If you bought a property today and all of the bills and expenses was paid, so you were smart, and like I talk about in another video, you actually account for capital expense, repairs, vacancy, property management, your mortgage, taxes, insurance, all the things. You account for that. And at the end of the day, you are breaking even on cash flow. Like you're not even making any cash, or maybe you're making like $50, okay? That does not sound very exciting. That sounds pretty lame. And it sounds like it would take you 150 years to build wealth that way. But here's the thing, that exact scenario that I just gave you, over years and years, you are paying down that loan. But the thing is, you're not really paying it down, your tenant is paying it down. So even though you're not benefiting right now, like you're like, man, this is terrible, I'm not benefiting, you're paying down that debt by the rent that's coming in. So theoretically, over the period of, let's say, 15 years, theoretically, which I'm sure you probably won't do a 15-year mortgage, okay? It's probably going to be a 30-year or 20-year, whatever. But let's just say, just for the purposes of this, just bear with me, that you had a 15-year mortgage. In 15 years, that mortgage will be paid off. So now, if that property, let's say when you bought it, that property was a $150,000 property that you had in it. At the end of 15 years, you have $150,000 of the property value at the time when you bought it. Now let's say, based on appreciation, let's be kind of conservative, and let's say 15 years later, that property has doubled in value, which by the way is conservative, but let's just say 15 years from now, instead of that property being $150,000, that property is now $300,000. Based on debt pay down and based on the appreciation, you have now $300,000 in equity. That's crazy. And when you bought the property, you ended up, it was $150,000 worth $150,000. So let's say that you put down 20%, you put down 30 grand. So now here's where like things just get crazy. It costs you $30,000 out of pocket if you put 20% down. And let's just say, conservatively, there's some closing fees. So let's just call it $33,000 or $34,000 that you had to come out of pocket. $34,000, but then every month the tenant was paying down that debt, and it was just appreciating over time. So let's just say that you could afford to do that just once a year. Basically, you did that for the course of 15 years. Then every year, think about, you're getting another $300,000 free and clear house every year you do that. So that's where like it gets really crazy as far as the debt pay down and the appreciation. Like you're building massive amount of wealth that way. And you have these different assets. Multifamily is awesome. I love multifamily, but a single family home, you can sell off one of those. So let's say, for example, that your kid right now is going to be going to college in 15 years. You can take a property, put a 15-year note on it, and at the end of that 15 years, that property is free and clear, it's cash flowing, and then at that point in time, you could say, okay, I'm going to sell it, or I'm going to not sell it, I'm going to keep it, and I'm going to put financing on it. I'm going to do financing on it. It's a $300,000 property at the time, but I'm going to basically finance $200,000 of it to pay for my child's education. Like, it's just amazing what you can do with real estate. And if you did it that way I just mentioned, by the way, you're not paying taxes on that $200,000 because it's debt. So it gets to be really cool. So cash flow alone is not necessarily what's going to set you free. Now, last thing I'll say with that, and then I got to move on because I don't want to make this too long, is cash flow is important. Cash flow is when you're able to have enough cash flow to support you and your bills and expenses and live the life that you want, you are financially free in that regard of being able to do the things you want to do. But at the end of the day, the equity, the debt pay down, like all of those things and the appreciation, that's what's really going to build you the big wealth down the road. So number 2, equity acceleration is really the wealth lever. So I've kind of talked about this a little bit, but you're able to accelerate equity in a variety of different ways. So number 1 is you can add value to a property by renovating it or fixing it up. So let's say you go and you buy a property and it needs some work, you renovate it, you put $20,000 into the renovation of the property, and now instead of it going up $20,000 in value, it goes up $40,000 in value or $50,000 in value. You have now forced appreciation by putting updates to the property, renovating it, fixing it up. You can refinance to pull out money tax-free. You can use this equity, this refinance, it's called BRRRR. You can utilize that to then scale up your portfolio of properties. So the third thing that you really need to understand also is the power of leverage. So often people think about leverage in a bad way. And leverage can be bad. Leverage can completely cause you to get wiped out. A lot of real estate investors got totally wiped out when the financial crash happened years ago. And it's one of those things that you need to understand how to use leverage the right way. You never want to get so over leveraged that you're at risk of losing everything. Don't do that. But leverage is powerful because it can magnify both the gains but also the risk. So again, you need to understand that. So what do I mean by that? I used the example I gave earlier. You've got a $150,000 property, you put $30,000 down, you got closing costs, so now you're at, let's say, $33,000. You use $33,000 to acquire a $150,000 asset. That asset is going to appreciate over the years. And so again, in the example I used earlier, 15 years is worth $300,000. And your tenants have paid that debt off. So you use the $33,000 to basically build out $300,000 of wealth in 15 years in the future. So when you use that and understand that, and you're educated about how to use leverage in a responsible, safe way versus over leveraging, that is something that you really want to know and understand, because that can help you really magnify wealth over time. The fourth thing that you really need to know is that tax strategy is everything in real estate. Real estate, it is one of the greatest assets. There's obviously some others like oil and gas and different things, but real estate is an awesome way to just take a huge advantage of the tax incentives that you're given. You always want to keep it between the lines, but the government actually incentivizes you to take these use these tax strategies. They want good housing for people. And so they know that they need people like us to provide that housing, that quality housing. And so you can depreciate your assets, your real estate assets on paper depreciate while they're actually in reality typically appreciating. So as the value is going up on paper, you're able to write off the depreciation. You can do that in a variety of ways. You can do that slowly over a period of time, or you can accelerate a lot of that depreciation on the front end. At the time I'm making this video, there's actually legislation to allow, once again, 100% depreciation, bonus depreciation, so that you can actually depreciate 100% of that asset on the front end of that first year and get all of that tax write-off on the front side of that. And that comes into play when you're a real estate professional, which there's certain criteria that you have to meet in order to be a real estate professional. But if you are, you can apply that even to your active income. If you're not a real estate professional, then you can apply that to your passive, like your rental income. And so if you have a good CPA and a bookkeeper and you get all this stuff figured out and dialed in the way you need to, you can say, okay, I'm going to take enough depreciation this year to wipe out all of my passive income. Or if you're a real estate professional, you're like, okay, I need to depreciate this much to wipe out my income to zero. And that's how you can legally not pay taxes. So that's something that's important. You got to understand how you can use the tax code to your advantage with real estate. Another option is the 1031 exchange. This is amazing. So a 1031 exchange, you buy a property, you own it for a while, and let's say 5 years in, this property has gone up dramatically in value. You sell that property, and normally you would have to pay taxes on that. You would pay capital gain taxes on that. However, you have the ability to 1031 that property and take this proceeds from the sale and roll it into another property. So now all of a sudden you buy a single family home, the value goes up, you 1031 and sell that, and now you take all the proceeds and you put that into a down payment on a quadruplex. So that is the power of the 1031 exchange. And then, as I mentioned before, you can do things like a cost segregation study to accelerate that depreciation on the front end so that you can offset a lot of your tax liability. And this is the way that the ultra wealthy people that are real estate investors can literally mitigate a lot of their tax liability. The fifth thing you need to know, and I think this is a tough one, even for me, I get caught up into this sometimes, buying right beats buying often all the time. So what do I mean by that? I mean that as you start to scale up, it's funny because I think it's pretty universal. Someone that goes out is like, yeah, I think I'm gonna maybe buy a rental property, just to supplement my income or whatever. Inevitably, they buy the rental property, they get a tenant, and if they do it right, they start getting cash flow, and they go, I want to buy another one, and then another one, and then another one, and then gradually over time they morph into what I call the deal junkie, and they're just all about let me do more deals. I want to do more deals. Buying right beats buying often. So one of the great things that you need to understand is when you buy real estate, the biggest way you make your money is on the buy. And so if you have a really solid, good rental property that you buy right, you acquire it for the right amount of money, that one rental property can outpace 5 other ones that were bought wrong, where you overpaid for the property. So don't necessarily get caught up in the vanity of chasing doors. For a while, I was honestly kind of caught up into that, and it was more of an ego thing, I think. Not that I'm an egomaniac or anything, but I'm super competitive at everything I do, and so I was like, I need to get as many doors as I possibly can. I need to scale up and just get ridiculous amount of doors so I can be like, hey, look at me, I got all these doors. And that can oftentimes be the wrong metric that you're looking for. What I would encourage you is instead of chasing doors, chase returns. Look at your returns and figure out your strategy that you're going to do to get you to your financial freedom, and focus on that versus vanity metrics like the number of doors that you have. Always be sure that you buy with equity and that you have a clear upside when you're buying. Another thing that I like to teach new investors too is like you need to have multiple exit strategies also. So it's a good idea when you buy a property, you're like, okay, I'm going to buy this property as a rental. I'm buying this as a rental, but could you turn around and tomorrow, if you had to, sell that property and make a profit? If the answer is no, then you really only have, you do have other strategies. Let me be clear. You could sell or finance it to someone or whatever. There's things you can do. But typically though, if you're buying a rental and you couldn't sell it tomorrow for at least a little bit of profit, you're probably not buying it at a deep enough discount to really get a lot of equity in the deal. So you want to buy with equity and you want to buy with upside. The number 6 thing you need to know is time in the market is better than timing the market. So often new investors that I talk to are very concerned about trying to time the market. They're focused on like, hey, interest rates are a lot higher than they were 2 or 3 years ago. Should I wait and let interest rates get lower? Hey, I noticed that, the market has kind of cooled off, as far as sales. Should I wait until the market picks up? Hey, should I wait? The stock market is kind of all over the place and there's a lot of fear and uncertainty. Should I hold off until things kind of like stabilize and that sort of thing? The answer is no. The best time to invest in real estate was yesterday. The second best time to invest in real estate is, the saying, today. Compound growth over time builds as the decades go on. I've talked even in this video, but a lot of other videos about how that you grow and build your equity as you pay down debt and as properties appreciate. So the sooner you get started buying property, the longer amount of time you're going to have in the market. And so I definitely don't advise at all buying bad deals. Note the thing I just previously said, number 5. But what I will say is, if you make a mistake and you buy something and it ends up not being a lot of equity in the deal, time can weather a lot of storms. So one of the great things about rental properties is it can be very forgiving with the amount of time. If you can ride the wave, then you're going to end up okay just because of appreciation and debt pay down. Now, if you buy wrong and you're losing a lot of cash flow and you've got a lot of properties that are losing, then that gets bad. How long can you stay alive until the market turns? But what I mean is if you buy a property and theoretically, let's say you overpaid for the property, but you still got enough cash flow to cover everything, you can survive that with time, because over time, rents are going to go up, debt pay down is going to go down, your equity is going to rise, appreciation, and you can kind of weather the storm. So remember that's an important thing, is time in the market is always going to be a better thing than trying to time the market, because none of us know the future. Things could change tomorrow. You look back with COVID, no one knew that was going to happen. Like no one had any idea that the pandemic was going to happen and cause the amount of chaos it did. But one of the things is the people that were buying during that period of time, I was one of them, really benefited with a lot of appreciation. And there were people that were running or jumping on the sidelines because of the uncertainty. The seventh thing I want you to know is systems and teams are what really can multiply wealth. So I have to admit something. I am not great when it comes to systems and processes. It is something that I have struggled with and I've really had to try to improve on over the years as a business owner and in multiple businesses that I've owned and investing. I'm very much a visionary. I'm a very much guy that takes action and sort of somehow just typically kind of gets things done and makes it work. Like, a prime example I talked about was that first rental property that I ever bought. I talk about that in some of my other videos. I was buying that as a flip. It didn't work out. I pivoted. I did this thing called the BRRRR, which at the time I didn't really even understand, going into it, what a BRRRR was, but I was able to do it and I made money and it cash flowed and it was awesome. But it's good to understand that as you're growing your real estate investing portfolio, as you're getting into real estate investing even, you need to understand systems and processes, and you need to have a good solid team. What do I mean by team? You don't have to go out and hire people when you first start investing in real estate. In fact, I would kind of say don't do that. But what you can have on your team is good quality people like property management. You don't have to pay a property manager a salary. Property managers get paid by the properties that they manage, the rent. Typically it's about 10%. Contractors. You don't have to pay a contractor a salary. You pay them basically per job. Don't pay them by the hour like I did on the first deal. Pay them by the job. So they come out and they quote a job and they say, this is what it's going to cost. Lenders, building a relationship with lenders, building a relationship with title companies, or here in South Carolina, we use attorneys. All of these people are a part of your team, and it's not like you're hiring a W-2 employee. These are all people that are a part of your team, and so it's never too early to start building your team. You need to, before you ever do your first deal, I would strongly advise, if you're going to have rental properties, to start interviewing property managers. I think it's a good idea to manage your first few properties so that you understand what it takes and what goes into that. But start talking to property managers and interviewing and finding out, learning a little bit about property management and letting them know what you're doing, and talk to contractors. Start talking to different contractors. You can, when you're looking at a deal, and again, I want to stress, don't waste people's time. I hate it when people waste my time. Don't waste people's time. But if you have a deal that you're really considering looking at buying, you got a deal, you're looking at buying it, this is a great time to get multiple bids from multiple contractors. So you're like, hey, here's exactly what I want to do to this property. I want to completely paint the interior of the property. I want to paint all of the trim. I want to paint the doors. I want to put in this type of LVP flooring that's going to be approximately $2.50 a square foot. Give them very specific information and then get a quote and have them quote it out, and then have 3 contractors quote that out. And then that's going to give you a really good understanding of how, number one, to price things, but number two, you may realize that these contractors are going to be way off in their pricing. I got to tell you a secret. A lot of times the contractors just sort of throw out a number. So you may see numbers all over the place. I'm not saying necessarily pick the cheapest one, but if you have the one that's the cheapest or maybe the middle of the road and you really like them and you feel like there's good rapport there and they've been able to kind of talk about previous work that they've done, then maybe you give them a shot at a small job, and that grows into where they become a contractor you use a lot for larger jobs. So building your team, having the systems and processes, that's very, very important to start that early. And the last thing that I will say today, number 8, that you need to know is your mindset controls your money. And what I mean by that is so many people think that talking about mindset, talking about that sort of stuff is woo-woo. It's, I don't care about that. Like get to the tactical stuff. Like I don't want to talk about that or hear about that. No, mindset is so important. Your mindset's going to control your money. So if you have a scarcity mindset, that's going to lead to you doing a lot of small deals. Maybe you're looking at deals where they're in bad areas because you've got that scarcity. Like, I don't want to spend a bunch of money. I'll do some of these deals that are in beat neighborhoods and the properties are beat, and that's going to deal with you doing a lot of smaller deals, and that's going to lead to a lot of other problems that you'll have with tenants. Confidence attracts capital and opportunity. So if you have this scarcity mindset and you're like, how are you going to go out and potentially raise private money and ask people if they want to invest in your deals and potentially give you hundreds of thousands of dollars? How do you do that if you've got the wrong, this timid, scared, how do you do that? Real wealth starts out with believing that it's possible. And you have to have the mindset of, I'm going to do this, I'm going to accomplish this, I'm going to fill in the blank. I'm going to create my financial freedom with real estate, and I'm not going to stop. I'm determined to do it. Grant Cardone talks about almost like being obsessed, like an obsessed person. I think some of the best entrepreneurs out there are really kind of obsessed with what they're doing. Like you think of people like Elon Musk and these guys out there doing these incredible things, like they're kind of obsessed about it. I mean, you kind of have to be a little crazy to be an entrepreneur, right? So as far as with investing, you've got to have the mindset that you're going to get educated and you're going to take action. Taking action is so important. You've got to have the mindset of abundance. You've got to be able to understand that sometimes you may be better off working with someone and giving them the lion's share of the deal because you don't know what you're doing. And so that's like, I found this deal, but I want to get 100% of it. I don't want to share that with anybody. Well, that's a scarcity mindset. What if you could find a really good deal and you could get a local investor in your community where you live to actually let you get an over-the-shoulder view of that, and you only got 25% of the deal, but they're gonna let you learn hands-on. That's valuable. That is crazy valuable. So something like that, someone with a scarcity mindset they'd be like, well, no, that's stupid. I could get 100. I'm not going to give 75% of the deal up. And they miss the point. Being involved in different communities, masterminds, going to conferences. I talk about our community. We've got an incredible community, and we're actually running a special right now. I've put the link in the description below, where for a very small amount of money, based on the amount of value you're going to get, you can join that community. You can get mentorship from me and others in the community. You can be a part of a group of people who are growing and building their real estate investing, their portfolio. They're on their journey together, and be a part of a tribe, man. I mean, it's like that propels you to such a faster rate of return that you're going to get long term. Like if you think about, and again, not to go off on too much of a tangent, but I just got to say, if you think about, I've used this before, everyone knows how to get a 6-pack abs. Like if you want your abs to have a 6-pack, everybody knows diet and exercise. That's it. That's what you got to do. Why is it so many people don't have a 6-pack? If everyone knows how to do it, why not? It's because they don't have the discipline. It's because they don't take action. They know what they need to do, so the education's there. So now they're educated, they know what they need to do, but they don't have the discipline. They don't take action. What about someone that has discipline, takes action, and joins a gym? They're going to have results faster. What about someone that joins a gym and gets mentorship or coaching? They're going to get their 6-pack. And so that's where being a part of a community, you're getting educated, you're watching these videos, be sure to subscribe and turn the notifications on. So that is the education piece, but then you need to take action as well. And so I encourage you, plug into your local real estate meetups, plug into our community, get plugged in and start taking action so that you can have the right mindset, you can learn from others, and you can accelerate your process and shave off months and months, or even in some situations, years. So appreciate you watching this video as always. I look forward to seeing you on the next one.